In this video, we're going to discuss another foundational options trading strategy, the long put. We'll walk through the fundamentals and show you how this strategy might fit into your investing toolkit. A put option provides the option owner with the right, but not the obligation, to sell shares of stock at a specified price, known as the strike price, within a set time frame. Let's use an example to clarify what this means and demonstrate how it could potentially be profitable. Imagine you've been eyeing a stock called FlyFit, and you believe its price might decline in the coming months. Currently, FlyFit is trading at $70 per share, but you anticipate it could drop to $50. In this scenario, if the stock does indeed decline, a put option may be a profitable strategy. You could, for instance, purchase a put option with a strike price of $65 that expires in 6 months. Then, if FlyFit stock does fall to $50 per share, you'll possess a financial contract allowing you to sell FlyFit shares well above the market price. On the other hand, if you're wrong and the price of FlyFit rises above $65 and stays there until the expiration date, your contract expires worthless. To acquire this put option, you'd pay an option premium. Let's assume this premium is quoted at $3. But remember, a standard option contract covers 100 shares of the stock. This is the option contract multiplier. So, for a $3 premium, you'd actually pay $300. Breaking down the math, if FlyFit stock falls to $50 per share and you decide to sell 100 shares using your put option, a buyer is obligated to pay you $65 per share, or $6,500 in total. If you bought the stock at its lower market price of $50 each, your total cost would be $5,000. By buying shares at the market price and then selling them using your put option, your profit is $1,500. However, factor in the $300 you paid for the put option, and your net profit comes out to $1,200. Just like a long call, one of the major benefits of a long put is its limited risk. The most you can lose is the premium you paid for the option. What's more, a long put offers leverage. Using the FlyFit example, with a mere $300, you effectively had access to market exposure on 100 shares of stock without the need to invest the $7,000 it would have taken to buy them directly. Though you could have simply shorted the stock, the potential loss from shorting can be unlimited, which would make buying the long put often a less risky choice. Long puts, also known as protective puts if you also own the underlying shares, are frequently used by investors to hedge their positions against potential downside. Say you own 100 shares of FlyFit, which is trading at $70 per share. That's a $7,000 investment. If you are worried about the price falling but do not wish to sell your shares, you can purchase a put option with a strike price of $65, for example. This way, if the price does fall below $65, your option contract will rise in value and offset the loss from your shares. Long puts also grant investors flexibility. If the stock doesn't decline as expected, you can let the option expire or potentially sell it before expiration to recoup some of the original cost. Of course, the long put strategy also carries risks. For example, if FlyFit stock price remains above your $65 strike price, you could lose your entire $300 premium. And like with long calls, time decay affects long puts. As expiration approaches, the option's time value can diminish, possibly reducing its value even if the stock price remains stable. More on this topic in another video. The long put, like its counterpart, the long call, is a cornerstone of options trading. While it offers the chance for significant returns, it's essential to understand the risks and rewards before diving in.